Let's look at some of the transactions involving notes payable. Notes payable could be a current liability, it could be a long-term liability. It just depends on when the note comes due. What is the maturity date of that note? Now, notes payable, sometimes people confuse that with accounts payable. What's the difference between notes payable and accounts payable? Accounts payable is almost always a current liability, and it results from transactions with your vendors and suppliers. So you have purchased things from your vendors or from your suppliers, and they extend credit to you. Maybe they give you 30 days to pay the bill, and that is trade accounts payable. It's a current liability because if you don't pay that bill, your vendors will stop supplying things to you. Notes payable is more formal. There's going to be a legal agreement, so a written agreement with a maturity date, with interest rates, with payment terms, with perhaps loan covenants attached to it. Loan covenants are basically promises that the borrower gives to the lender. They are provisions that banks can put into loan agreements to protect the bank. For example, maybe there's a loan covenant that says the company needs to maintain a current ratio of a certain amount, or they may need to maintain a certain level of working capital. A note payable will also have some language in the agreement that talks about default. What if the borrower does not repay in full? What could happen? Could the bank repossess something? Could the bank have other remedies like exercising a personal guarantee against some of the owners? So the notes payable has more formality associated with it than the account payable that we see. Now, if we take a look at a situation here, let's say that on November 1, so all the way over here on November 1, we borrow $100,000 from somebody, from a bank, from another lender, whatever that may be. So we borrow $100,000. Now, I'm sure that plenty of people watching this discussion have borrowed money. You may have a loan for a vehicle, you might have a mortgage for your house, and with those types of loans, you remit payments on a monthly basis, and a portion of the payment reduces the principal balance that you owe, and another portion of the payment is interest expense that you pay to the lender. We're going to set up a scenario here that's a little bit less common. You do see it sometimes in business, but not so much in consumer lending. In other words, what I'm trying to say here is we're going to borrow this money on November 1. We're going to borrow $100,000. And we're going to get all the way over here to Halloween of the next year. Okay, so all the way to October 31 of the subsequent year. And this is where we're going to repay the $100,000 principal, but we're also going to add interest to it. So we're going to pay the interest and the principal 12 months later. Kind of an odd scenario, but it could happen. Sometimes lenders do create unique and creative strategies for lending to companies. Maybe this is a startup business that needs to watch its cash flow. So the lender is willing to extend a loan of $100,000 and then wait a year to receive the interest. Now, what's happening with this situation is, we have 6% interest. Now, if we take a look at this overall, 6% interest for the entire year, the math is not particularly difficult. We're going to have interest of $6,000 for the entire loan for 12 months right here. That's not difficult math. So we can see that at maturity, we as the borrower, we're going to have to pay $106,000. And that will be a repayment of the $100,000 of principal that was loaned to us, plus 6% interest. Here's where the little snag comes in. If we are a calendar year financial statement reporter, in other words, our financial statements measure things from January 1 through December 31, we're going to have something to do right over here. On December 31, we need to make an adjusting journal entry because there's the reality that we have borrowed this money for 2 months, but we have not paid any interest expense. When I think about interest, I think about it as rent. If you rent somebody's property, you have to pay money to them. In this case, you're renting money. And when you rent money from somebody, you pay rent, but we call it interest because you're using their money. So here's what's going to happen is that we have to take a look at the amount of interest that has accrued, that we've incurred for these 2 months. Ultimately, what's going to happen here is at the end of the year, we're going to need to record a journal entry that debits interest expense and credits accrued interest. Sometimes people might call it interest payable. Either way, regardless of what caption you choose to describe that, it's a current liability. Now in this case, we're going to have to come up with some numbers and figure out how much we debit, how much we credit. In other words, how much interest expense did we really incur by borrowing money for 2 months in 2018? And corresponding with that is how much is the current liability that is this little chunk of interest that we are going to have to pay, but we're not going to pay it until Halloween of next year. We can't escape journal entries forever. So let's look over here. So at the very inception, okay, on November 1, the journal entry is pretty straightforward, quite frankly. You're going to make a debit entry to your cash account, whatever checking or savings, whatever bank account that is, and then you're simply going to make a credit entry to notes payable. And it really is as simple as that. Now, sometimes it might not involve cash. Certainly could be that we borrowed funds in order to purchase a building or a piece of equipment or a vehicle. And in those cases, you would debit the appropriate account. Equipment, vehicles, buildings, et cetera, whatever that might be. But in this case, it's cold hard cash. Let's take a look at how this is going to affect the accounting equation. Over here, we see that assets are increasing by $100,000. And we see over here that liabilities go up by $100,000. Nothing happens to stockholders' equity because we didn't do anything that involved the operations of our company. We didn't do anything to generate revenues or to incur expenses. This was solely a balance sheet transaction. Assets increase, liabilities increase, and then we move on. So we borrowed the money, but remember that journal entry we're going to need right here at the end of the year. Because, and remember, we're dealing with accrual basis accounting here. So in other words, we had this reality that we incurred a cost, we borrowed the money, that cost called interest expense needs to be on the income statement for 2018, at least those 2 months worth. So how do we come up with a dollar value? Well, let me just put the structure of the journal entry here first. We debit expenses to make them go up. So we're going to have some sort of debit here. And if you make a credit entry to a liability, in this case, accrued interest, that will go up. The question is the dollar amount. Now, there are a couple ways to handle this. We're going to deal with, first of all, simple interest. I know that you may be watching this and what I'm about to do, and you'll say, well, what about compound interest? Well, you're absolutely correct. But we're keeping it simple just to illustrate this cutoff that we have to deal with as far as recognizing, measuring the expense and the liability. Expense for a certain period, the liability as of a balance sheet date. So one thing you can do is you can use this formula right here. Actually, I think of a little more space over here. Interest is equal to principal times rate times time. So in our case, our principal is $100,000. Our rate is 6% per year. It's important to know that it's per year as opposed to per month or per day or something like that. But of course, 6% per month or per day would be usurious. I mean, it would be a humongous rate, but that's per year. And so then we get over here and you have the time. Well, the time is a fraction, 2/12, right? 6% per year, which is 6% for every 12 months. And we have 2/12 right here. If you do the math on this, you're going to come up with $1,000. It's not particularly difficult there. And that's going to be our debit to interest expense, and our credit, we didn't need a second dollar sign there, credit to accrued interest. Right? After we post this journal entry, we will have this expense on our 2018 income statement, and the balance sheet at the end of 2018 will depict this current liability. Now, I had mentioned there's a couple different ways to take a look at this. Sometimes I'll just look at it as simple as this. If we borrowed this money for the entire period of 12 months, which we will, okay, for the entire, this period right here, it is going to be $6,000 for the entire loan. But we need to break that up, right? We've got $6,000 spanning 12 months. The thing is that 12 months spans 2 calendar years. Well, if you do this, you come up with an average interest expense of $500 for each month. So you can kind of conceptualize it this way as well, that every month that we borrow the money, we owe $500 worth of interest. And since we have 2 months where we borrowed the money here, that's $1,000. That's another way to think about that. That works if the numbers are really nice and even and round, but this is really the way you want to tackle an interest calculation with this formula over here. And I almost forgot to mention this. As we think about that $1,000 of interest expense that's related to 2018, after we record the journal entry, let's look at what happens here. Okay, when we credit accrued interest, our liabilities increase by $1,000. But nothing's going to happen on the left-hand side of the equation. It's all over here on the right side. Stockholders' equity actually decreases by $1,000. That's what keeps the accounting equation in balance. You see, the debit to interest expense is ultimately going to reduce the company's net income by $1,000 because additional expense leads to lower profit. So stockholders' equity ultimately will go down because retained earnings will become smaller. Liabilities increase because we have this current liability. We owe $1,000 as of the end of the year. We just are not going to pay it until 10 months later. Now we're going to take a look at what happens all the way at maturity for this particular loan. We already know that the interest expense associated with the first 2 months of borrowing is $1,000. And really, remember how the rate was $500 per month? And I said that you could kind of do a quick and dirty back of the napkin type of analysis. Well, over here we can certainly do that. And we're going to see that the interest associated with borrowing the money for 10 months during 2019 is $5,000. Of course, we can prove that to ourselves as well with the formula. Right? Principal is $100,000. The interest rate is 6%. And then the time component, well, this is actually going to be 10/12 because now we're trying to measure the interest cost for 10 months out of 12 for the entire loan, so 10/12. And that comes out to $5,000. You can really kind of do this either way, but what we're seeing now is we're measuring the interest expense for this time period versus this time period. So let's record this entry. Now we're all the way over here. Okay. Happy Halloween, trick or treat. I don't know if this is a trick or a treat. You're paying money, so maybe it's a trick. But let's take a look at what we have to do to record this entry. Now, on one hand, think about what's happening on the maturity date. We're going to repay this loan. Remember how we had made a credit entry to the note payable account back in 2018 when we recorded the note payable? Now we're going to make a debit entry to that account because the liability is going to be going away. There's another liability that's going to go away. Remember our friend accrued interest. Once we pay everything in full, there will be no more accrued interest. So that's going to go away. We also have to record the interest expense for the current period. That's the $5,000 that we just mentioned and measured in the previous discussion. And then ultimately, we know debits have to equal credits. Remember that the entire payment is going to be $106,000 because that's what we owe. At maturity, we have to pay the $100,000 principal plus $6,000 of interest. So let's just look briefly at what's happening with this journal entry. We're going to write a check, or we're going to send a Venmo or a PayPal or ACH, but either way, we're giving the lender $106,000. You make a credit entry to cash, that account will get smaller. We are recording the interest expense for 2019. That's 10 months worth of interest expense. That is the expense that belongs on the 2019 income statement. And that's much greater than the $1,000 we recorded last year on the 2018 income statement. And it should be a greater amount. We borrowed money for 5 times as many months during 2019. Then that accrued interest that we had recorded at the end of 2018, that goes away, and so does the note payable. So at the end of the day, we have a little bit less cash, but the liabilities are all gone. How does this affect the accounting equation? Let's take a look at that in just a second. If you need to rewind and take a look at that journal entry, please do. I needed a little space. I had to erase it here. But let's look at what the impact is on the accounting equation after we post that payment October 31 at the maturity date. We're going to see that overall assets decrease by $106,000. That's the check that we are writing. And liabilities go down, but they only go down by $101,000. Let me explain why that's the case. Because the accrued interest, which was a current liability, goes away. So does the note payable. Now, obviously, you know that this equation wouldn't balance. And you also know the earth stops turning if accounting equations don't balance and if debits don't equal credits. So we know there's something else happening over here with stockholders' equity. And the reality is that stockholders' equity is going to decrease by $5,000. And that's not just the amount that makes this equation balance. It does. A decrease of 5, a decrease of 101 equals a decrease of 106. But that's not the reason. The reason is this is the expense that will be reported on the 2019 income statement. That $5,000 of expense will cause net income to be $5,000 lower. Ultimately will cause retained earnings to be $5,000 lower than it otherwise would have been. So what we're seeing is this decrease in assets somewhat gets rid of some liabilities, but it also makes stockholders' equity lower because we had to incur an expense because we rented somebody else's money, and that's called interest expense.